Hello, ladies and gentlemen. Welcome back. And today, I am actually excited to bring to you guys what I would consider is a must-own stock in just about everyone's portfolio. However, what I do want to go through in depth is whether or not right now, here and now, is the right price target. Is it selling for the correct price? Is it selling overvalued, undervalued? Is it fair value? What is it? I'm going to get into that. The stock that we're talking about is going to be Intuit. And this is a stock that I actually did own, but it was about 2 years back. My average share price was around $179. But unfortunately, that was during my adolescent investing years, and so at that time I was actually swing trading, and so I didn't hold on to those stocks. Unfortunately, I sold off all my shares of Intuit, and I have not bought in since. I did make a pretty good profit. However, I should have kept it because I would make a lot more, but times have changed, and so has the market. So let's take a deep dive into Intuit and see if now is a good time, or if maybe we should just wait a little bit longer and see if the market pulls back. So before we blab on anymore, let's get right into it, huh? Alright, ladies and gentlemen, the way I'm gonna do this video is I'm gonna break it up into 3 segments. So section or segment number 1 is going to be pretty short because this is just going to be what is Intuit. I'm going to be telling you about the company. I'm going to be telling you about what kind of products they have, where in the sector do they serve. They're going to be in the technology sector, okay? And what Intuit is, just an FYI, so Intuit is a boring company. However, bear with me, because boring does not mean not profitable, because this company is an absolute powerhouse in the accounting, tax filing, and financial planning software business. So Intuit is it's a business and a financial software company intertwined. They develop and sell financial, accounting, and tax preparation software, and other related services like that. But they sell it to the small businesses, which is really good. They sell it to accountants, and they also sell it to individuals. So that means that their market is actually pretty big. They target a lot of people. What we're going to do is we're going to switch over. I'm going to show you guys their product line, because it is quite extensive. It is all software related business, so it's just going to be things that you can download, purchase, and put into your computer. They help with your taxes. I mean, they have a lot of different products, and I know that you guys have probably heard of at least a few of these because they have QuickBooks. I know you guys have probably heard of QuickBooks. They use TurboTax. Not use, but they own TurboTax. Which is a huge acquisition that they actually made. Quicken. So they have a lot of different products that they can give to the people. They are really aggressive, and the next section is going to go over the technical analysis of the company, and the last section is going to be about financials, and you guys are really going to see that this company is a powerhouse. I mean, they have an incredible balance sheet. Very, it is literally one of the top balance sheets in the world. So I try not to bring you guys really bad companies. So that in and of itself, in a nutshell, well, that's Intuit. It's a tax preparation type company, and they just cater to a lot of different needs. So without further ado, the next section that we're going to get into is going to be a technical analysis. I'm going to show you guys a little bit about that, and I hope you guys have a little bit of fun with that one, because that's actually where I started. So without further ado, let's get right into that. Okay, ladies and gentlemen, for the second section, I want to structure these videos in a more digestible way, and also in a way that allows you to see and utilize the two main ways of evaluating a company, okay? Which, the first way, which would be from a financial standpoint. The financial standpoint is something that we preach a lot on this channel. That's going to fall in line with your 10Ks, your financial statements, etc. Okay? Which we are going to touch on in the last section. But for this section, we're going to be focusing on the second way to evaluate a company, which is from a technical viewpoint, which is actually how I started out investing. If you want to really call it that, because when I started, I was actually day trading and swing trading, so I got started that way, which is why I started out on the technical side. But I actually think the technical side is a very good way to start out, because it's very easy. You don't have to know anything about the company. You don't have to know anything about the financials. All you have to do is just focus on a chart, just like the one you see here in Robinhood. Okay, so there's two different types of charts. There's a level 1 chart, which is what you're going to get here on Robinhood, which is simple, but it's effective. It gives you the basics, and it gives you the information that's good. The second chart is going to be the level 2 chart. That's going to be your most advanced type of chart. That's going to give you any information you possibly could want. However, it can be very overwhelming, and there is a learning curve to it. Not a very steep one, but a learning curve nonetheless, okay? So for the time being, we're going to stick to the simple Robinhood one. If you guys want me to step it up to level 2, I'll be more than glad to do that. Just leave it in the comments, and then we'll take a look at that on the next stock that we take a look at. However, without further ado, let's get started on this technical analysis. I'm not going to spend a whole lot of time on it. So what we're going to do, first and foremost, is you're going to want to get, I like to get the most history you can possibly get. So unfortunately, Robinhood only gives us a 5-year. I wish they would give us, please Robinhood, give us like full life of the company. That would be really good. The more information, the better, especially when it comes to technical analysis. So when you get your 5-year, okay, what you're going to want to do is you're going to want to expand it. Get the whole thing opened up. That way you can see it nice and big, and you can see the chart. You can see the pattern formation. That's the most important thing. You can see the formation that the chart itself takes. Every single stock has a pattern that it follows. It's not always predictable. However, there's a pattern that does form. So as you can see, this one does have an upward trend because it's going all the way up. This company's been very profitable. However, you can see that it has fallen on a hard time right here, which is actually just recently. This one happened in March 16th, so that was actually quite recently, which is where every other company got hit. So what you want to use the technical analysis for is this is going to gauge where the stock is trading at right now compared to where it was in history. Now for me, I'm going to use it because I recently purchased this stock in 2018 at a share average price of around $179. So that would be what, right around here somewhere? Yeah, so that's 180, right around here is actually right when I purchased it. So what I would do is I would say, okay, well, I purchased it right around here. Well, we're going to come all the way to where this stock is now, and we're going to see just how much it's risen, and we're going to see, has that point been tested? And by tested, I mean, has that stock price hit its resistance level and bounced back? Has it hit its resistance level and gone below that? You know, how has it reacted? Has it been tested? Is it been stabilizing in that area or not? As we can see, since I sold off, this stock has risen, and not only has it risen, but it's stabilized. It's come down, but it's also gone back up, which means that it's been proven to be stable around the frames of about $200 and so to around $263 where it sits currently. Okay, so what we can definitely tell is, well, 263 compared to its high of 304, it looks like it has definitely some growth left on it, but from a technical standpoint, this stock would be a little bit on the overvalued side, especially since what's going on in the market, and we know what's going on in the economy. We would know that just from a technical standpoint, it does not have too much growth, right? $263 to $304, that's not a huge percentage. However, we know that the market is due for some more turbulent times. We do know that it has come all the way down here. So you see right here at $201, that's its resistance level. That is the lowest that it's gone in the most previous moment. And that's going to be our bottom. Okay, so we know that this stock has actually quite a bit more to drop before it even hits its last resistance level. So from a technical standpoint, I would give this a hold. I would not buy this stock from a technical standpoint. However, when we get into the financials, which is why you want to combine both ways of evaluating a company. You want to use the financials to know exactly what's under the hood, and then you want to use the technical to know exactly where you stand within the history of the stock, so you can really gauge and see what would be a good level to buy this at. Just from a technical analysis right here, right now, not even knowing what the financials are, right? I would not buy at 263. What would be comfortable to me? I would start being interested in purchasing this company around the $218. Once it hits $218, I'm going to start putting this stock on my watch list, and I'm going to probably start loading up when it hits around its resistance level, and that's when I would start building a position, because if you buy in around its resistance level, and then the stock goes up, okay, well then you can just sit on it and then just react and see where the market goes, or where the stock goes. However, if you buy in at that resistance level, buy in at like 10% of what your cash is, or however much you want to invest in total, and if the stock continues to go down, well, that's good, because then you can continue to build your position and continue to cost average down and build a bigger position, and then inevitably when the market recovers and Intuit recovers and stabilizes, you'll be able to recoup all the profits on the upward trend. Okay, so from a technical standpoint, this is not a buy right now, but we're going to get into the financials and we'll see if that sways our mind just a little bit more, okay? Okay. Listen. The technicals, I know that they may have said that this stock right here and right now is not a buy. However, I told you guys that this stock is an absolute powerhouse. So let's find out why, because it's all underneath the hood. When you actually take a look at their 10K report, this one right here is their 10K report from 2019. That's their most current one. If you scroll down, you will see their consolidated statements, okay? Now, the unfortunate thing is I prepped for this video yesterday when their stock price was $249, so it actually went up. So my math is going to be a little bit wrong on one of these figures, which doesn't make a big deal at all, because it comes down to, you know, how much of a difference it is from when I bought it to when it was. So what I want to get into is the growth that this company produces and just the overall consistency that they do it at. I mean, this company is very strong. So the first thing that we're going to want to take a look at here is total net revenue, okay? And we're going to be comparing the 2019 numbers to the 2018 numbers, even though they do give you all the way back till 2017, but I'm doing a comparison between when I purchased it in 2018 till now. So between 2018 and 2019, they had a total net revenue increase of 12.5%, which is fairly good, okay? Especially when we're talking about a company that's bringing in billions of dollars. Now, this is a big, large size cap company. This is no small time thing. So to bring in 12.5% revenue increase is very, very good, okay? Especially year over year, because they're pretty consistent with that number. Now, the next one that we're going to want to take a look at is the net income, okay? Now, the net income from 2018 to 2019 went up 17%, okay? That is big. The net income going up 17% means that they are not only growing revenues, but they are holding on to that profit and increasing that profit actually more than they're increasing their revenue. So that means that they're either bringing down some of the cost, as you guys are going to be able to see that they actually don't have much cost from their products and everything like that. I mean, it's software, so once it's on there, people download it. I mean, this is a beautiful, beautiful way that they run this company. So a lot of it comes down to the selling and marketing and things like that, and research and development, because they have to stay on top of their stuff. But one very, very exciting thing, if we scroll down to the bottom, is this is a dividend play, people, okay? Their dividend increased 20.5% from 2018 to 2019. That's huge. They're paying $1.88 per share annually. That is very good dividends, okay? This is a very strong company that pays dividends, which means that they have shown stability. Now, with the economy being in this situation, we all now know, oh, dividends, bad word. Stock buybacks, bad word, right? That's not the case for every company. You guys have to understand, dividends originated from companies that were formed and stabilized. They had a foundation that just was almost impenetrable. It couldn't be cracked, really. So companies have exploited dividends and taken advantage of them, and this is not one of those companies that has taken advantage of dividends, okay? They pay healthy dividends because they can. So let's do this. Let's show you guys why. Let's scroll down here, okay? And let's go to their current assets. If you guys take a look at their current assets and look at their cash and cash equivalents and investments, I want you guys to see that with those combined, year over year, they have increased that 59.6%. They are holding on to about $2.7 billion in cash and investments. That is huge when you take a look at what their debt is. Their debt, their long-term and short-term debt, ladies and gentlemen, this is not fake news. They virtually have no long-term and short-term debt. Look at what it is. Short-term debt, $50 million. Long-term debt, $386 million. They can literally cut a check tomorrow and pay that entire thing off, okay? This company is, I mean, they just know how to run a business, and they know how to run a balance sheet. So they literally check off every single box. And their acquisitions that they make, they just purchased, I think, not just purchased, but there is a rumor going on around there, and I'm pretty sure it's not even a rumor. I'm pretty sure it's actually been validated. But Intuit is set to purchase Credit Karma for about $7.1 billion, if I'm not mistaken, which would be huge. Now, obviously, as you guys can see, they don't have that much money in cash, so that does mean that they probably will in the future be taking on some form of debt. However, as it stands right now, they virtually have no debt. And when they do take on that $7.1 billion in debt for Credit Karma, well, Credit Karma is going to be highly profitable for them. So I am fairly confident that that is going to be something that they aggressively pay off. And something that in the future is only going to provide more growth for Intuit, okay? So, excuse me. As we can see, their cash and cash investments and equivalents is phenomenal. Now, their total assets from 2018 to 2019, that has also increased 21.5%. Okay, so we have seen nothing but increase in growth from this company organically, and they've been paying down their debt. Actually, surprisingly, they paid down like $2 million in their long-term debt, which is pretty funny. So their liabilities and everything aren't a problem. They are going to be hit in this recession. They are going to be hit in this economy. However, once everything stabilizes, everyone has to pay off their taxes. Everyone's going to have to use their accounting software. Businesses are going to have to get back up and running, and Intuit's going to be in prime position to take advantage of all that, take up that market share, and continue to grow into the future. Now, when I purchased this stock in about 2018, I had around $179 average share price, okay? When I made this prep, it was yesterday. The stock was selling at $249. This is the number that's going to be a little bit skewed because obviously the stock is selling for $263 today, so it had a good day. However, that's an increase of 39.1% from when I originally purchased in to what it is right now. So, from an investor, I have to take into consideration, and I have to figure out it is well, at this point in time, let's just call it an even 40% increase. Is paying a 40% premium, because that's what I'm paying, is a premium, right? Is it worth it? Do I think I'm getting that value back? Is Credit Karma enough of an acquisition for me to spend a 40% more premium, or is this a situation in which I'm going to have to hold on and see how the markets react and see how it affects this stock? So in this current situation, I do firmly believe a long-term play, I do firmly believe that $263, even back then at $249, I had this at a fair value. So if you were to purchase in at this price, or even if I was to purchase in at this price, I am not, however, going to purchase in at this price. I've tapped out all my resources currently. But if I was to purchase in at this price, I would not be mad. If it was to go down, I would be happy because then I'd be building into a higher, better position, a stronger position, and I know that the upside is going to be there eventually because I know that the fundamentals of this company, the fundamentals is the financials. You will find the fundamentals of the company in the financial reports, and the fundamentals have not changed for this company. What's changed is the overall surrounding atmosphere, the economic collapse, the global recession, everything. Okay, so that is what's affecting this stock, not the company itself, and that is the key. That is very, very important. So that's why even at 263, I would not be hurting if I purchased in at this price, and I wouldn't be sad at all if it went up, and I wouldn't be sad if it went down. So with that all being said, ladies and gentlemen, that is my overall take on Intuit. That's my technical analysis breakdown. That's my financial breakdown. Overall, I have owned Intuit. I currently do not own Intuit. I would, if I had excess money, I would buy into Intuit. Yes, I would. However, I do not, and I do not plan on purchasing into Intuit anytime soon, simply because I have started some recent positions that I want to build out first. So that's going to take some time. So as of right now, Intuit, great company. I hope you guys learned something. Like always, please show some support. Follow me, subscribe, comment. Let me know what you guys think about the video. Let me know what you guys think about what's going on out there in the market. If you guys have anything you guys want me to take a look at, write it in the comments. Let me know. And if you guys have Robinhood, I will pin a comment down below with a link that'll take you to a promo code. If you put that in there, we'll both get a free stock out of it. We'll both make a little bit of money, and that doesn't hurt nobody. So I hope you guys enjoyed everything, and like always, stay strong and invest on.